This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long, and I have again with me this morning Charles Hugh Smith, well-recognized writer on the web, who is the publisher of the website of twominds.com. Charles, so welcome back.
Thank you, Gordon.
Enjoyed our first session. We began our dialogue on the Federal Reserve, and I'm looking forward to following through here today. You've written a number of really great articles this month that really talk to the Fed, and one of them that resonated with me, and I have up here right now a slide because I really feel a lot of it, and we talked about it in the first session, perceptions and what I would term propaganda that really is resonating from the Fed and perceptions of the Fed. And you related it to something called the cargo cult. And I guess that comes from maybe some of your experiences in the Pacific. Could you take us through that?
Gladly. The cargo cult phenomenon occurred after World War II in the South Pacific. Very interesting phenomenon because when the U.S. won the war in the Pacific, it left huge depots of supplies and goods that it no longer needed and was not worth trying to haul back to the United States. And so the residents of these islands, of course, greatly missed that huge flow of technology and free goodies that the U.S. brought in as part of the war effort. And so they started what you might call like these sort of cultist religions that based on the premise that if they painted radio dials on rocks and danced around a fire at night and this kind of thing, that the huge flow of free cargo from the U.S. would start up again and they'd have all that free stuff. And of course, from our point of view, this is ludicrous. But my point here is how different is that from what the Fed is trying to do by creating what they call the wealth effect, like trying to boost housing again, trying to reflate the housing bubble so that everyone will feel wealthy. And even though they're not wealthier in actual money in their bank account, they will go borrow and spend more money, and that will stimulate growth. And I think the point here is if the Treasury issues us a tax refund, that's actual real money. It's transferred to our account. We have $1,000 that we can then spend. That is different than what the Fed is doing, which is actually running a persuasion campaign to make us feel wealthier so we'll go borrow more money and therefore enrich the banks and then spend more money. And it's really not capitalism, because capitalism is more based on saving money and loaning it out at a favorable rate of interest for a productive enterprise. Capitalism is not borrowing a bunch of money you really can't afford and then squandering it on consumption. So it goes to the heart of what's capitalism and what's crony capitalism and what's unsustainable spending based on debt. And so that's the cargo cult phenomenon as we see it in the Fed.
Yeah, capitalism is producing more than you consume. So therefore, even if you're given money, that money has to be put into something or done something with that in fact will produce more than you're going to consume with. And that's what we're happening now in the most simplistic manner from a capitalist standpoint, is all we're doing is consuming, we're not producing. We're not producing any wealth. We're passing paper around, but we're not producing wealth. And how you measure that wealth would say, okay, what's your net exports from the country? What are you exporting out of your fixed closed system versus what you're importing? And when you see that go negative to the degree that you have, and we're all well aware of it, it says you're not producing sufficient enough and you're consuming it. And that's what we've done. We're eating our seed corn every single day, and we've got so fat and so lazy, we don't even go and plant the fields anymore. We sit at the granary and just eat the grain.
If we move to the next slide, there's another aspect of consumption and lack of productivity, which is it's called diminishing return or marginal return. And it's when you keep pouring money down a rat hole and there's no yield from your money. There's a diminishing return on your investment. And this slide shows what's happened with housing. The Treasury and the Congress and the Federal Reserve have all poured in trillions of dollars in credits and giveaways and guarantees into the housing sector to try to reflate the housing bubble. And it's basically staggered along for 4 years. And so the question is, what else could we have done with those trillions of dollars? Why was it so important for the Federal Reserve to dump trillions of dollars to support housing? And they're continuing to do that. Well, it's to save the banks because they want homeowners to not declare bankruptcy and not get out of their mortgages. They want them to keep paying the bank's interest even if they're underwater, even if their wealth has been destroyed by the collapse of the housing bubble. So this goes to the whole question of, is the Federal Reserve's policies, are they encouraging productive, sustainable capitalism, or are they encouraging diminishing return, speculation, and malinvestment? And we know the answer is they're encouraging malinvestment.
And we've spent a full show just talking about exactly that, or a couple of them. I have a chart, Richard Hugh, who wrote the book, The Holy Grail of Macroeconomics, and is a real believer in that we really are in a balance sheet recession. And throwing more money at it. And he would put this out when we were in the early stages of quantitative easing, not QE2 or QE3 and now unlimited. But he pointed out, and it's a good example of it, that the central bank's implementation of QE at a time of zero interest rates was similar in the analogies he used to a shopkeeper who, unable to sell more than 100 apples a day at $100 each, tries stocking the shelves with 1,000 apples. And when that has no effect, adds another 1,000. As long as, the point is, as long as the price remains the same, there's no reason for consumer behavior should change sales, and sales will remain stuck at the same price. So throwing more money at the problem, just all it's doing is buying time to hold up the assets that should be brought down. In your housing example, if we brought housing down to another level, it would start to move again. It would.
Precisely.
But I said, okay, there's going to be a lot of people hurting. Yes, that's what makes the capitalist system work. Because the capitalist system works because there's risk. But profits are about the risk level that you take and whether you're rewarded for the risk. Bad risk decisions, you're penalized, called bankruptcies and failure. And when that happens, it isn't that everything shuts down. You bring down the investors lose their money, the senior bondholders lose their money, and somebody takes over that asset and can make it run at a lower price. But everybody's got this impression that when it goes bankrupt, we just shutter the whole thing. It's got to be a very, very bad operation to shutter it all. It just says that the break-even point's got to be brought down. And right now we're trying to run a banking industry where the break-even for bad decisions and bad investments is dramatically lower. It's very simple. It doesn't mean that Citigroup would be shut down. It means that ownership would change and bondholders would get crushed, not the depositors. Matter of fact, Charles, I would argue that, when we brought in deposit insurance, we actually removed the role of the Federal Reserve. Because the Federal Reserve was really created to stop bank runs and, in fact, to protect the depositors. But that was before we had deposit insurance. And so we've removed the fundamental underpinning of why we originally brought it in. We're not pricing risk correctly today, and we're not penalizing those who took excessive.
Yes, and as this slide shows, the Fed is trying to make money cheaper. So they're trying to push more debt on a society and an economy that's already over-indebted and over-leveraged. And so this is illustrated in this slide of the life cycle of the housing market, that when you push cheap money, then people are over indebted and they're over leveraged, and the process that has to take place is deleveraging. The mortgage has to be written down or paid down, or incomes have to go up. And as we saw in last week's show, incomes for the bottom 90% of American workers are stagnant. So people aren't making any more money. They're actually losing purchasing power thanks to the Fed's 2 to 3% inflation. So you have here a complete breakdown of the system, that if you don't allow assets to drop in value, and you don't allow banks to be destroyed and to have debt written off, then you have this sort of zombie economy where the incomes are stagnant. No one can borrow. Nobody has the desire to borrow because their income is flat, and they're concerned that the assets will decline in value. And so the Fed has basically created a zombie economy.
And the only people who suffer in a zombie economy is the bottom 2/3 of the country in terms of income are the ones that really pay the price. And this chart up here really shows what happens with excess money printing, call it quantitative easing. And I would argue, I bet you there isn't 1 in 1,000 Americans who even knows what quantitative easing is or even possibly have heard of it. But what we're doing, and we talked about it in the first show, is we're penalizing those who used to save, and we do that zero interest rate policy, or zero says there's no money in it, so you're clearly penalized. But on the other hand, we're rewarding, as we speculative risk through easy credit and leverage. And so, as we said in the first session, the poor become poorer and the rich become richer in this whole process.
Gordon, before the show, you raised an extremely important point that you were discussing how the Federal Reserve policies, or actually its very existence, is creating systemic instability. We're not building or creating or adding to our economic stability here. The whole Federal Reserve policy is creating instability. By jacking up assets like the stock market to create like a phony wealth effect that's supposed to stimulate even more borrowing, even though we're already over indebted. The whole system is becoming increasingly unstable, not stable. And so I think I'd like you to speak to that how do we get back to a stable, sustainable, productive economy?
Difficult question. It really is, because once you get into the beginnings of instability, it feeds on itself. The oscillations just get larger because the momentum feeds on itself. That's what we've created with unintended consequences and moral hazard, and taking on higher levels of risk, higher levels of speculation to get the kind of return. So therefore, when you make a mistake, the disastrous kinds of, when you're running 50-to-1 kinds of leverage, which people are having to go to, or at least 35 and north, when you have such low rates of return, you have to be at that level, suddenly 2 or 3% loss, you're insolvent. So the level of oscillations are getting larger and larger. When you have instability like this, it just feeds on itself. And unfortunately, the only way you can get it, you can't have it with low interest rates, because low interest rates force and feed more leverage. It means you need more leverage to make money, and it's cheaper to get the leverage. It's not taking it away. And then you say, well, we're in the process of deleveraging. No, we're not in a process of deleveraging. We're in a process of non-performing loans which are blowing up, can't deliver, and therefore you call it deleveraging. I would call it our insolvency, but we don't have bankruptcies because we flush more money or into a dead body. We call it zombies, life support system, to keep it artificially alive. But it's still dead. It's still non-performing. And so there's this instability that we've created. And there's only one way out of it, Charles. You have to lower the prices. You have to have, if you would, deflation. You've got to bring it down so that assets produce more than they consume.
Right. And as you've said in previous shows, what we're really talking about is reintroducing the market's ability to price risk and assets. And the Federal Reserve policies are basically inhibiting the market from pricing goods, services, assets, and risk.
Precisely. That is precisely it. I don't know if so much that they're doing it intentionally for that as it is an unintended consequence, because it's the only tool and the only way that they believe that the problem can be fixed. And that's what needs to be changed, because it stems out of the fiscal side of the house and the government public policies. What we should be doing.
You're right. The Fed has two levers. It can lower interest rates and it can print money. And so what we're really saying is it's doing all it thinks it can, but that's actually incredibly counterproductive for our economy.
Exactly. And it's driving us in the wrong direction at an accelerating pace, because that's the only fuel and engine it has. Unfortunately, it's creating higher and higher levels of instability. And until the captain of the ship realizes that he's charging at the rocks, nothing's going to happen until we hit those rocks. And the captain of the ship is not the Federal Reserve. The captain of the ship is our political apparatus. Comment I used in our first show from Chuck Schumer had put to Bernanke, well, you're in charge. Well, no, he's not in charge. Quite the contrary. The public elected officials are in charge of policy. And that's where it needs to start. But they've abdicated totally their responsibility. So, as you can quite gather, I'm very much opposed to the Federal Reserve and a lot of the things it's doing, but I don't hold them totally responsible.
Yeah, that's an excellent point.
It's very difficult for them to say, well, we can't do more by lowering interest rates, because there is a possibility of a benefit of it. But right now, and we've showed in previous shows, that we have diminishing marginal return. That is, it used to be that for $1 worth of stimulus spending, we would get $2, maybe $3 of short-term stimulus that would push into the economy. Hopefully it would sustain itself and feed on. That stopped. That stopped in 2008, 2009. Now you get 33 cents, maybe 28 to 33 cents. In other words, you lose money. For every dollar you add, you may get 33 cents worth of growth. So if it doesn't work. So in actual fact, with the rate that we're currently going with the expansion of the Fed's balance sheet and the creation of money, it won't be long before the Federal Reserve will be taking all assets onto its books, and frankly, we'll end up owning America if we're not careful.
And that's part of what this whole diminishing return, where the Fed keeps pouring money into the economy, printing money, shoving money into the banks at 0%, and there's no return in terms of like sustainable growth and rising income. It's just not there. The policies are not creating a good return. The return is completely diminishing. And so that's really the issue. If your policy is not productive, then obviously it's failing.
We're talking about the Federal Reserve. This is a global problem right now, generally in the developed countries. And on the left, I'm showing the rate of expansion of the money supplies from all of the central banks. Is frankly what we have is a race to the bottom of currency wars, of trying to debase your currency at a faster rate and give some kind of advantage as we push out more money. But the bigger problem that we're seeing, Charles, is that real growth around the world is not there any longer. And the real growth around the world has typically stemmed from the United States and has come out of the United States middle class. That's why I talk so much about it, because as a 71% consumption economy, and with the United States being 25% of the global GDP, it has been the engine. Now, the rest of the world, China's around 35%. Most of the developed countries are 50 to 55%. We've hit a wall. We talk about the fiscal cliff. I believe we have a consumption cliff. So when you erode the middle class, like we're doing with all of the expenses and compression of real disposable income, you've stalled the world's global growth. And that is clearly, even the World Bank says it's 2.5%. IMF says it's just over 3%, which is, by the way, global basis, 3% is in fact a recession. But when you're using a deflator of 1.8 and food prices is 10%, it says the numbers are bogus, absolutely bogus, which there's no question that they are. So the real world's GDP currently in real value is negative. So we're contracting. So you have more and more people fighting for smaller and smaller piece of a shrinking pie. And that's why printing money is not going to restart the engine. It's just not. We need to figure out how to get real growth stimulated again. And growth, see, we have going on something that we tend to forget about. We've had a massive redefinition of work and how we productively employ people. The internet has obsoleted so many people in terms of clerical and manual exercises, the whole supply chain, which is a wonderful, wonderful thing. But we've taken out millions and millions of jobs, ever mind the millions and literally hundreds of millions of new jobs that we need to create. We have Schumpeter's mass destruction happening on such a scale today that we fail to realize it. And we're fooled and perceptions and propaganda that we have growth. We do not have growth. We have contraction.
Right. That's a very good summary of the connection between growth and jobs. And I think that our next series, we will be talking about the future of work. And I would just add to your comments that really what the Fed is doing is its job is to push more debt. It's to get people to borrow more money. And the problem with that is that you create interest that eventually saps their income. And so really growth comes from saving and productive investment. not from taking on more debt and creating more leverage. And that's the only tool the Fed has, is to push debt and leverage. And that's what we're really talking about, is that's not the path to growth. That's the path to a zombie economy and then eventually some sort of crash.
It all will lead to that, whether we want to use the word crash, but a readjustment where we will bring prices in line with their real productive capability so that assets themselves will produce real revenues or real profits. And we will stop the level of consumption that's wasteful consumption, where we're just consuming. And that's the resetting that we have to do, because we've had such a degree of mispricing and malinvestment that's taking us to a level where now the economy is basically dysfunctional.
Right.
And we have so many false perceptions and so much spin going on that's translating into dogma that we can't even seem to argue the realities of what's in front of us. So we've got blindfolds on, and we can't. Our political apparatus itself, because of how costly it is to run elections, how costly it is to get a vote, how you need sponsorship, and the polarization that you have and gridlock within the political apparatus, you can never get difficult policy decisions forward until you have a crisis. And that's when people generally come together out of desperation, fear, and anxiety into a change. We just have to hope, Charles, that when that happens, and it will happen, that the change that we do and the decisions that we make will point us in the right direction. Because unfortunately, history is replete with examples of what happens is the person who stands there with a solution and everybody scrambles to is not always the right solution or the right person. And the one that I think of is Hitler in the 1920s, who had a solution to the hyperinflation and the same bad policies that the Bundesbank was exercising then as we're doing now, unlimited money printing, led to such destitution with the middle class and absolute social chaos in Germany that this crackpot, who had a solution that people believed in, and it started to work some magic, took control of a country, and we all know where it led. But the German people were not stupid people. They were in desperate need of real solutions, and because of the Versailles Agreement, had almost no choice, or perceived they had no choice. So we better hope that when that day comes, that we go in the right direction. We have to wrap, Charles. I hate to land on such a negative note, but maybe it is a fair warning of what we have to be cautious of.
Yes. Well, we've put off the reckoning and rebalancing for 4 years, and we've accomplished nothing but increased our debt and leverage load. So we do need to move in a more positive direction.
Looking forward to having you back next month, and we're going to pick up this discussion. We're going to talk about work, the nature of this shifting work, and then also bridge it back, as we said at the beginning, to some of the changes at fiscal policy that are causing this, because clearly, discussion here this morning suggests a lot of that needs to be in the area, but also the issues that we're seeing with the policy pressures on our Constitution. And these are all part of this roadmap that is moving us in an unfortunate direction to possibly higher levels of statism. So until next month, Charles, all the best.
Okay, thank you, Gordon.
Talk to you later.
Okay.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.